Hi there, and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. This week, we're talking with Taylor Kryskowiak, Vice President and Investment Strategist at Themes ETFs. Taylor, thanks for joining me.
Thank you for having me. It's a pleasure to be here.
Absolutely. So, Taylor, I'd love it if we could start by talking about your ETF, the Themes Generative AI ETF, ticker symbol WISE. What is the strategy behind this ETF and how has it performed?
So the strategy, as its name would imply, is investing in companies that are exposed to artificial intelligence. Now, there are a lot of different definitions one can use in constructing a fund, but the one that we've implemented in developing the index that this fund tracks is focusing on four specific areas and selecting companies that have at least 50% of their revenues derived from one of these four, which is artificial intelligence directly, big data and analytics, natural language processing, or AI-related services. So if we look at AI as kind of the next big rush, as it was in the gold rush or an oil rush or an extracting of any other natural material, we know that it's not just the end product. There are lots of steps along the way. Those who are selling the picks and shovels, proverbially speaking, those who are transporting that material to market. And the same can be applied to the AI space. And we're looking to gain exposure to every single one of those pieces of this proverbial puzzle to give you the most exposure you can to this theme. And importantly, we weight this fund. No individual holding is more than 5%. And we select 40 companies that meet that criteria to give you exposure to that theme. And in terms of how it's done so far, we're very pleased to report that since its inception, year to date, and over the last month ended in February, it's outperformed not only the Magnificent Seven, the NASDAQ 100, and the S&P 500 on a total return basis. It's also outperformed all of the 10 underlying indices that are tracked by other AI ETFs. And again, outperforming all of those indices net of fees. It's also worth noting that our fee for the WISE fund is arguably the lowest out there of any AI ETF that gives you exposure to that specific theme, only 35 basis points, which is roughly 50% below the category average for AI ETFs.
I'm glad you brought that up, Taylor. You mentioned the 10 indexes and how WISE is outperforming all of them. You also mentioned that this is a category low in terms of the expense ratio. So that's one differentiating factor of the ETF. Better performance, lower expense ratio. It seems like there's a lot of advantages to this ETF versus other AI ETFs, but are there other differentiating factors that you could point to that investors, can look at and say, okay, this is the AI ETF I should be buying over the other ones?
Yeah, absolutely. I think one of the consistent themes that I've seen in speaking with investors and financial advisors alike is they ask, what is beyond Nvidia, obviously being, I think, the massive poster child for the AI movement in the last month with those blockbuster earnings, but looking beyond Nvidia, beyond the Magnificent Seven to see what else the fund owns. And I would actually say that in kind of analyzing the attribution performance, it's because we've held exposure beyond those seven names, because we've only capped those weightings at 5%. We have been able to give exposure to names that are perhaps smaller and may have more room to run in terms of performance. We know that the Magnificent Seven, Nvidia are all household names at this point. They've dominated the headlines. And as a result, and as more mature companies, just mathematically, they have less room to run than perhaps a newcomer onto the stage. One of the more notable holdings that we hold in the WISE fund was SoundHound AI. If you remember, this app a long time ago was one of the precursors to Shazam, and now has become a front runner in the natural language processing part of this market. So as its name implies, this is what helps translate the natural English that you and I are speaking into actual commands that an AI can utilize and has been used in whether it be in autonomous vehicles and the commands and verbal prompts, because it has had that history of data analyzing lyrics of songs, for example. And when Nvidia announced that it would be investing in SoundHound, we saw a nice pop in the stock, which is translated to performance in the fund itself. So that being, I think, a small microcosmic example of how we've invested beyond just Nvidia, the Magnificent Seven, and given you meaningful exposure to some of these smaller names. And importantly, I think one of the other major differentiating factors, as I mentioned, we have a 5% cap weight to these names. So up until the most recent rebalance in the fund, which occurred a few days ago, Nvidia had obviously run up and it was beyond that 5% cap, up around 7% of the total fund. And after this rebalance, we actually reweighted it down to 5%. Now that's a market difference from some of the other competing AI funds, one of which I think you've actually covered, how they've increased their max allocation weight to accommodate larger holdings, specifically Nvidia being one of the main forcing functions there. So we have decided to make a decision to stay away from weighting any individual name too highly and keeping at that 5% cap to give you, again, that diversification across these 40 different names within the fund.
That's great. And Taylor, you mentioned that there's been some incredible performance in some of these smaller AI names like SoundHound and Supermicro. Obviously, everyone's been watching that one very closely. It's doubled or tripled extremely quickly. Do you worry about AI stocks maybe getting ahead of themselves and there being froth in that part of the market?
There's certainly a valid concern there with the sort of uptrend that we've seen in the space. A lot of folks have made comparisons to the dot-com bubble. And I think it's important to recognize that unlike the dot-com bubble, valuations, I think, are fundamentally different here. And they're grounded in sales and real dollars and cents that are being funded by big tech that has a lot of cash on hand. Those balance sheets are flush with capital to put to work. And many of those biggest names, the Magnificent Seven, are putting those dollars to work to stay on the cutting edge of AI. Jeff Bezos, I think, had that infamous quote that companies, if they stagnate, they die. So I think that, there is this big rush to stay on that bleeding edge in the AI world. And, there's a comparison I think has been circulated comparing the rise of Nvidia to Cisco back in 2000. I think, while those charts look similar, it's important to note that the valuations are a far cry from each other. Cisco at that time, at the height of the dot-com bubble, was triple the valuation of what Nvidia is now, which I think speaks to the fact that while, again, it is a high valuation, it's nowhere near, I think, that level of froth that we saw in the dot-com era. And importantly, when we take a look at the sort of economic impact that AI is going to have, all the way down from the micro at the individual business level, increasing operational efficiency, all the way to the macro global economy, when we see the sort of incremental value that AI is going to add, it's hard to underestimate the incredible impact that it's going to have across all industries and in really improving both operational efficiency and generating additional economic value.
Finally, Taylor, I want to ask you about how an AI-themed ETF like WISE fits inside of a portfolio. Who do you ultimately see using this ETF?
So I think it fits in a portfolio for all the reasons that we discussed, which is really a play on the long-term prospects of artificial intelligence as a technology. And it can compose part of your core holdings, particularly if you have a long-term time horizon, you're willing to wait out any volatility along the way. Right now, that volatility has been to the upside. There is a potential that we could see corrections in the space. So that being said, if you're in for the long haul, it makes a lot of sense to hold an allocation to this fund. And conversely, it will supplement some of your core holdings in the benchmark indices that you would ordinarily see comprising your prototypical stock bond portfolio, because I think we're in an era where the macroeconomic narrative supports some of these targeted exposures. I think we now live in a more normalized world where interest rates are no longer 0%, money is no longer free, valuations and are no longer rising across the board. And as a result, it's going to require some of these targeted plays to give you that sort of portfolio performance over time that perhaps some of these major benchmark indices may not be able to provide as they had done over the last 15 years, just by virtue of the fact that we, again, are in a more normalized environment. And just mathematically, where we take a look at the discount rate, that earnings and those valuations on stocks are going to be a lot harder to achieve that same rate of return. So that's where, a concentrated position in something like artificial intelligence, I think, makes a lot of sense for investors, depending on your risk tolerance and your time horizon.
Fantastic. Well, this was a great discussion, Taylor. Thanks so much for taking the time and sharing your insights with us.
Thank you so much for having me, Samit. I sincerely appreciate it.